All right, let's talk about Southwest Gas, ticker SWX. Their latest earnings call, it was about a lot more than just the numbers. What we're seeing is a company right in the middle of a massive strategic pivot. And honestly, it all kicks off with a bit of a puzzle.
So here's the big question, right? How on earth does a company beat profit expectations, but its stock still drops? I mean, it's the kind of thing that makes you scratch your head. You see a solid earnings beat, but then the stock ends the day in the red. It feels like a riddle, but the answer tells you everything you need to know about where Southwest Gas is headed.
And here are the numbers, plain as day. Look at that earnings per share, a solid beat, 53 cents versus the 42 cents Wall Street was expecting. But right next door, you've got a miss on revenue. So what did the market do? It sent the stock down almost 2%. See, these mixed signals, that's our cue. That's how we get to the real story happening behind the scenes.
So let's talk about that big change, the pure play pivot. See, here's the thing. The market wasn't just reacting to one quarter's numbers. No, it was trying to figure out this massive transformation that's going on. Southwest Gas is moving to become what we call a pure play utility, super focused.
Okay, this lays it all out. Think of it as a before and after. Before, Southwest Gas was this kind of complicated holding company. It was trying to be a gas utility and run a construction business called Century. Now, a lot of times when a company does that, it gets hit with what's called a conglomerate discount. Basically, the market just gets confused and values the whole thing for less than it should. So the goal now? Simple. Get rid of the complexity, focus on the core gas business, and create a story that investors can actually understand and get excited about.
And how did they kickstart this whole pivot? With a huge chunk of cash. We're talking $470 million. This came from their first big move, selling off a piece of that Centurion business we just mentioned. This was no small deal. That's nearly $500 million in cash, ready to fuel this big change.
So, what do you do with $470 million? Well, you do a major financial cleanup. They took that money and went right to work paying down debt, a huge move that makes their balance sheet so much stronger. It worked so well, in fact, that management came out and said they won't need to issue any new stock in 2025. And that's great news for shareholders. It's all part of the plan, right? Get the finances in order on the way to a full separation from Centuri.
Next up, unlocking regulatory wins. Okay, so the finances are looking cleaner. That's step one. Now the company can focus on making its earnings more predictable, more stable. For utility, this is where the game is won or lost. It's all about the regulators.
Now, to really get this, there's a bit of jargon you need to know. It's called alternative rate making. Just think of it like a regulatory fast pass at an amusement park. The old way, the traditional way, utilities have to go through these super long, super expensive cases just to get permission to raise rates to pay for, new pipes and stuff. This new way streamlines the whole thing. It cuts down on that delay, what they call regulatory lag, and makes their earnings way more predictable.
And here's the deal. Southwest Gas has been on an absolute winning streak lately on this front. I mean, look at this. In June, Nevada passes a law that opens the door for this stuff. In July, Arizona approves a new capital tracker. And in California, they're getting super close to a settlement. These aren't just little wins, you guys. This is a big deal. It's fundamentally de-risking their entire business model.
But, there was a little bit of a catch. That win in Arizona, it came with an unexpected $50 million cap on the investments that can get this fast pass treatment. Management was pretty clear on the call. That was a surprise, not part of the original plan. So now they're looking at their options. Do they ask for a do-over? Do they just move up their next big rate case? It's definitely a detail we need to keep an eye on.
All right, let's talk about the next growth engine. So, just to recap, the balance sheet is getting cleaner, right? And the regulatory picture is getting a whole lot clearer. So the big question is, where does the growth come from? Well, they have a very, very big answer to that question.
And wow, this chart right here pretty much says it all. That little bar, that's the current capacity of their Great Basin pipeline. And that giant bar next to it, that's all the new demand from shippers. And you want to know what's driving this? It's the insane energy needs of all the data centers and tech facilities popping up out there. We are literally talking about demand that is almost 7 times what they can handle right now. It's huge.
So how much does it cost to meet that kind of demand? We're talking about an investment opportunity between $1.2 and $1.6 billion. I mean, think about that. This is the kind of massive project that can completely define a company's growth story for the next decade.
And listen, this isn't just some pie-in-the-sky idea. There is a very clear roadmap here. They're targeting to have this thing up and running by November of 2028.
The next big step is to lock in all those contracts with the shippers who want the capacity. After that, they'll file for federal approval in late 2026. So yeah, it's a long-term project, but it's a catalyst with really clear milestones along the way.
All right, it's time for our take. This is the next call. So let's put all the pieces together, right? You've got this big strategic pivot, a much cleaner balance sheet, some key regulatory wins, and this massive growth project on the horizon. So, where do we land on this? What's our call?
We're rating this one Outperform, and here's why. We think the market's knee-jerk negative reaction on earnings day just completely missed the point. It missed the bigger, much more positive story that is unfolding right now at this company.
And our reasoning here is really simple. It's based on everything we just laid out. First, that balance sheet is so much cleaner now, so much less risk. Second, those new regulatory wins, that gives them much clearer visibility into future earnings. Third, you've got the Great Basin project, which is just a huge, rare growth catalyst you don't see every day. And finally, this whole pivot to being a simple, pure-play utility. We think that's going to attract a whole new set of investors as the story gets easier to understand and, frankly, a lot more compelling.
And you know what? Management feels the same way. The CEO, Karen Holler, said it herself. We are confident in our path forward as a premier, pure-play natural gas business. That kind of confidence, when it's backed up by the actions we've seen, is exactly why we expect the stock to outperform as more and more people start to understand this powerful new story.
And of course, just a reminder, this is not financial advice. Please be sure to do your own research before you make any investment decisions.